Hello, everyone, and welcome back to Your Finance TV. Looking at the week ahead for you and different things that could be intriguing for you this week in the markets, like the CPI, earnings, and maybe we'll have a little bit of look at the three L's as well. As always, we have Brendan McCarty back to talk to us about the week ahead. How are you, Brendan?
Great, back from a week vacation and fired up and ready to go.
Fantastic.
Hope I don't
All
sound
right.
it.
Before we jump into the show, don't forget to click on that the subscription button. Numbers keep on growing. Thank you very much for your support. Okay, we have CPI data out on Wednesday. And isn't there going to be some close attention to this number, Brennan? With the Fed not meeting in August, this CPI release could lead to another rate hike ahead of that break. It's quite clear that the minutes and comments from Fed speakers, they aren't happy where we are with inflation data and that Powell wants it lower. The market is giving it a 90% probability of a 25 bip hike coming. And isn't that, in the whole scheme of things, Brendan, is it that big of a thing? Should the market start finally listening to what the Fed speakers are saying? Could we see another 1% of hikes before the end of 2023?
I think the debate comes down to three factors. First, the system, the financial system, pricing pressures, and where the current rates in the market are. So basically where the market believes things are going. For the system, the banks are still relatively weak. That's what I use for the proxy. If the banks are strong or the banks are stable, that argues that the financial system is stable because they're making money, and we'll talk about them a little bit. But it argues that if they're making money and they're doing well, that means the financial system is generally stable. They haven't really bounced much since March, when the Fed plowed billions of dollars into the system. Everything else has bounced pretty good. Look at the NASDAQ; it's up like 30% since March. But the banks haven't. So the financial system isn't in the greatest position right now. Wealth accumulation around it is doing well, but not the banks. Second is pricing pressures. Pricing pressures have come out pretty good over the past year, as we all know. But it appears that they're turning higher again, which could be why these Fed speakers are acting the way they are, in terms of like fearing the next, or fearing what happens next, so to speak. This kind of coincides with liquidity's turn. As liquidity has turned higher this spring, thanks to the Fed, this stabilized prices in some cases, turned demand higher. So rising prices and rising demand is not exactly the best recipe that Fed wants to see, which could argue what's going on. Also, if you add in the Dallas Fed's trim mean level, which is I like to use, it's a PCE, to their own measure down there. It's a good measure that I've used for years. It's a 6-month forward number. It's 4.3%. So it's still above the Fed's goal, which is not what they want either. Third part is the market risk. And when the market rates right now are rising, I think the 10-year went over 4% for the first time in a while. 6-month forward rates about 550-ish, which argues that the market is pricing in another hike. So I think the market, as long as the market keeps pricing in hikes, the Fed will go slowly and match those hikes. I think we're back to the point where the Fed's not driving rates up the nose of the markets, but more of matching what the markets expect. I know the 2-year is not where it should be, but if the market goes slowly, if the Fed goes slowly enough with rates, that could actually get the 2-year to rise higher and equalize out to the Fed, but to equalize out over the longer term. So long story short, I don't think the Fed's going to go on a hiking campaign of expect another 1%, but I would watch the market. The market is the proxy. If the market continues to price in hike after hike after hike, you watch it. But I don't think the Fed's going to go over those levels. They were going 75 basis points last year, and that was like 50 basis points higher than the market. Then they'd go 75 more. That was another 50 basis points higher than the market expected. So long story, I would say that they'll follow the market on the way up. And I think right now the market is pricing in another 25. So you'll see 25. If the market continues to price in more, they'll continue to follow the market higher.
Okay. All right. Now, earnings season is back, and it kicks off with the major banks, like we were touching on there before. JP Morgan, Wells Fargo, Citigroup. Banking deals remain quiet, but starting to trickle back in. But usually in a rising rate environment, we see banks perform well. But during the last 12 months, that has not been true. The XLF ETF is down nearly 2% over that time. Now, obviously, we've had the smaller banking crisis during that time. If you remember that, remember Silicon Valley Bank? Everyone seems to have forgotten about that. But Brendan, why do you think that the financial names are underperforming?
So this goes back to our previous conversation with the banking system not performing. The rapid hikes hurt the banks, hurt them badly. You got to go. One of the things I think, I don't know if it was Greenspan or somebody, they always said, stay with the market. Don't go higher than the market expects. And part of the offset, part of the reason for that is you're going to hurt the banks that make the banking system go round and round. So the rapid hikes over the past year hurt the banks. They also created competition for cash. So basically, your bank account was earning nothing, but a T-bill was earning 2.5%. What are you going to do in a market that's fallen down? You're going to buy T-bills at 2.5%, or you're going to go into a money fund. This created a drain on the banks, and when they have a drain in their their deposits, they can lend less. Lending less means less revenue, less earnings, and still competition is fierce for this money. We have a money market fund yielding 5%, I think, right now for the company. I mean, that's fantastic. First Republic is not giving me 5% of my deposits. So what do you think I should do? Well, I'm going to go into the money market. So that competition is hurting the banks, and you're seeing it in deposits. They're not exactly surging. It also doesn't help the banks right now. The equity markets and the wealth creation, the economy is high. Again, the Nasdaq's up 30% in the past quarter, or since March's lows. So I guess that's more than a quarter. But I mean, where are you going to put your money when you see a Nasdaq up 35% versus even 5% in money? Your confidence is back. You're probably buying in there. So that money leaves the banks as well. And I bet the best proxy for this is, let's look at the chart. If you look at the forward earnings for JP Morgan versus Morgan Stanley's numbers are expected to be higher. JP Morgan's expected to be lower. So that argues that the banks are just suffering from the environment. This will end over time, I believe, if the Fed slows the rate hikes, keeps the rate hikes, or at least in line with what market expects, lets the banks start to lend with more stable rate conditions, and you'll see better revenue. But right now, the curve is still all messed up. 2 years is still lower than funds. The 10-year is at 4% versus funds, which will probably be 5.5%. We need the curve. You need the curve to normalize for the banks, and I think that's what the outright banks are going to hurt. They don't have a diversity. I mean, JP Morgan does have a brokerage outfit, but it's dwarfed by its banking operation. Morgan Stanley has a huge wealth division, and it dwarfs its banking division, and that you can see it in terms of forward earnings. So I think the banks, it's a tale of two cities. If you have a wealth division that dwarfs your banking division, you'll do fine because you're benefiting from all the other assets that you sell. If you're a bank, you're seeing lending less. You're seeing tightening lending standards, which argues for lesser lending. You're seeing deposits stable to falling. It's not the best situation to be in. In the current, the BKX shows this, and that's a problem for the banks in general. It's probably why the Fed probably won't get aggressive either. They're afraid to upset the apple cart of the banks. Got to give them time to breathe. I remember in 2000, one of my proxies for, I think it was this year or last year, was the banks would do well in tech stocks. I think it was last year. Banks would do well and tech stocks wouldn't do that well because the banks came out of the bubble doing very well. They stabilized for several years. They worked under the rate regime that didn't show 75 basis point hikes at every meeting. So I think that's what we'll eventually see from the banks, but we may be a quarter away from that. It's just, I think I gave you a chart that shows 2011, 2008, 2020, they sat down here for a very long period of time. Then the rest of the market slowed, rates curves normalized, and the banks stabilized. So right now it's about wealth management driving earnings. It's not about banking products, lending and whatnot. And that's going to hurt the banks. That's why you're seeing it in the earnings for this quarter.
Okay. Well, talking about earnings, let's move on to Delta Airlines. And they report Thursday pre-market. Their share price is inching towards pre-pandemic levels. They raised their forecast in late June, saying they will hit the top end of forecast for operating margins and EPS. But as we know, a month is a long time in the market. Oil prices are higher. Travelers are frustrated with flight cancellations. And interest rates are going higher, as we've touched on. Wage pressures are growing as well, Brendan. Stock has been flying this year and into these numbers. And is this move justified, and can it continue?
So I think we've been talking about the airlines versus Airbnbs and hotels, and the airlines just continue. Them and cruises tend to be are doing very, very well. It's kind of funny though. You got to fly somewhere, you got to stay somewhere. Why would the hotels and the Airbnbs be weaker? But maybe they're just too strong prior to that. But the airlines have been indeed strong in the 23. Delta and the XAL have looked very strong. Interesting numbers on Delta is trading at 8 times forward earnings. I don't remember the last time an airline traded that cheap in my lifetime. If you looked at compared to the S&Ps at 20, analysts expect its dividend to like quadruple into next year. That's a key driver. Not only are you getting price appreciation, but an airline is actually giving you a dividend. I mean, what world are we living in here? Revenue growth expect to be up to 20% this year. That's a big deal. Revenue alone will drive the product, especially if it's rising revenue. I think earnings are up 90% year over year. So what's driving the fundamentals going in for 2023 are driving DAL. I can't help wonder though if energy prices are going to cap it from here. I like to look at Delta and all the airlines relative to crude oil. It's a very boring measure, but it's nothing. It's a lot of like how I look at Tesla and Bitcoin together, related products. And Delta has like sprinted away from energy prices, but energy prices haven't exactly fallen. So it's kind of weird what I just said, but essentially, usually when Delta is like really rallying, it's because energy prices are sinking. You have that nice mix. Right now, we're not seeing that at all. In fact, crude, I think, is back over $73, if I'm not mistaken. It's not falling. So it's like that rubber band. You keep stretching it and stretching it. You're not getting enough going the other way. So while Delta's chart looks great right now, I wonder if the weight of energy prices is about to hurt them. I don't think in the short term that's going to be an issue. The chart does look stronger, but I think it will cap the next level. I don't think it has much more room to run. Also, Delta's story will shift. We're going to be like 2023 numbers are fantastic for Delta, just like as I said. 2024's numbers don't look as great. So if you're not growing earnings at 90% and revenue at 20%, whereas you're only growing at about 5%, any uptick in energy is going to start to hurt you. So I think once we start shifting into the 24 outlook, Delta will slow. It's kind of funny. I think that seems to be a theme across a lot of earnings stories. But I would just say Delta in the short term looks good. The numbers support the climb. If they were to surprise with any negatives right now, that would not be expected. Look out below. But chart looks good. The analysts are, I think, behind a little bit, and I think investors are pushing it. So the short-term story is pretty good. Longer term, maybe next quarter when the discussion next year comes up, that could slow the gains and put the business model back into question.
Okay. Well, another one reporting is Conagra Brands. That's simple CAG. Their Thursday pre-market. And we talked about the CPI and inflation earlier. And we could see that impacting these earnings. Share price is down 14% year to date and down 5% year on year. When we look at analyst recommendations on this name, no one has a sell on it and is dominated by hold recommendations. The median price estimate of 41.5. They did surprise last time though. So with this sell-off that we've seen into this earnings release, could there be a surprise to the upside, Brendan?
Possibly. I doubt it. I would say that we've talked about this several times. We started with General Mills about a year ago on this. Like, you continue to raise prices and sacrifice revenue to increase to hold margins. Conagra did the same thing, and now GS and Conagra are both paying for it. In fact, I think GIS just missed, if I'm not mistaken, as part of our 3Ls. And if GIS, I mean, Conagra did raise last quarter, but it's lower numbers. So it's like, all right, we're going to be low. We're going to sandbag the numbers, and then we're going to raise them a little bit. So they lived off price increases and sacrifice revenue to guide them over the past year, and that came home to bite them over the past 6 months. There is a price point for everything. Substitution for goods does exist, and I think the consumer moved away from their higher price goods. I think they were living off frozen, if I'm not mistaken. Tyson's of the world would be an interesting read on how they're doing. But anyway, while they beat on earnings side last quarter, it was still lower in both revenue and earnings from the previous quarter. And now this quarter is expected to be lower in both those levels. In fact, back to the beginning of 23 levels when things were actually turning higher and getting better. If the company can say that costs have fallen enough, that their price mix is back in order, steady revenue, steady earnings, steady margins. That's the picture that Conagra investors want, because they got to feed the dividend. Right now, the dividend is not expected to grow much into next year. And I think that's what's also hurting the stock. You buy Conagra for its dividend. You don't buy it for its price appreciation. But right now, if you're a dividend stock and you're not named Microsoft, Google, or Amazon, you're probably not going up anyway. But I would just say that they need to get their product mix back into order. They need those revenues to stabilize. They need to stop living off price increases, which I think they are at this point. You're starting to see grocery chains start to, like Albertson's been flatlining for 9 months. It's starting to turn up. I think that argues that their price margins are improving, which argues Conagra stop raising prices at the local level, which could drive more revenue for them or hurt their margins, one or the other. The stock's not really trading well. It will come to outlook next year. The analysts are not, I mean, the market, if they get a better mix for next year, that's what the outlook is. Okay, I was just saying for Delta, 24 is the focus. I think if Conagra can say, well, we're ending 22, so this will be 23. If they end 22 better and say 23 is going to improve better and we have a better mix, that could stabilize the stock. If they say anything negative, they could just drop like GIS did. I mean, General Mills got hammered. So I wouldn't be surprised. Conagra could get hurt if they don't come in. I mean, they expect to be lower already. If they miss already lower numbers, that could really hurt the stock.
But I'd like to diverse a little bit on that one as well. Why are analysts not having a sell recommendation if that's like the trend we're seeing in this space?
Do analysts ever put sell recommendations on anything? I mean, it's hard to put a sell recommendation in a bull market. The markets are what they are. I mean, analysts are herds. They all follow each other. I think they got surprised by what Conagra did by just constantly raising prices. Most of these analysts have never seen an inflation story or an inflationary environment. None of us really have. I mean, unless you're 70 years old and you were in the markets 50 years ago, sure, you saw the 70s. But I'll just say that I don't think we're prepared for the rise, and now they're not sure what the fall is going to be like. You know what I mean? So inflation is a nasty little animal. In fact, like wage inflation, I think came in the latest employment report higher or was stable. They're suffering from that. But what if Conagra goes to AI in the product lines? They can drop costs that way. So there's different ways that they have to lower costs and get their mix back in order. Inflation is that little disease that's been running through it, and the analysts don't know how to look at that. I mean, I think that's my figure. With technology, it's a little more straightforward. You know, inflation is not such a big deal in technology outside of the wages. So I think that's why the analysts just don't have a clue here. It's also a staple. It's hard to argue when the markets are up so substantially to sell a staple, because usually they're the next ones that you want to buy when everything else sells off.
Yeah.
So again, analysts don't usually get anything right. So what do you expect?
A good old conviction call of the hold. All right.
Yeah.
Let's move on to the 3Ls. And I've done a tricky one for you this week. It's
I like it.
All companies reporting on Friday pre-market. So straightforward, and everyone can wait till the end of that, probably in preparation before you get into Friday earnings. All right.
It's like black and red, black or red.
Let's start with JP Morgan.
I like it. Breakout over 142.50 look positive. It looks like it can go for more, even as I say earnings are moving lower. Go anyway.
Second one we're looking at is Wells Fargo.
I don't think I've ever liked it, but I do like it this time around. Over 41.50, and then it climbed over the 65 weeks. So trend looks higher.
Okay, next one is State Street, STT.
I leave it. It failed at the 65 week and then fell under the breakout point 74. I would have thought, it's funny how these charts are all saying opposite what the earnings picture is. Anyway, go ahead.
All right, next one is BLK Blackrock, and obviously a lot of speculation around with that one right now.
Yeah, this is predictable. I like it because passive assets are benefiting dramatically right now. As their SPY and their NDX products are doing well, so it probably will factor through to asset management fees. So I like it. Held above the 65 week. It's not the strongest of charts. That's the one negative, if you will. But if anything has learned over the last 6 months, passive investing has probably regained some leadership.
Okay, next one is Citigroup.
Citigroup is once again a dog. It was a dog for many years and finally a dog again. I would leave it. Looks weak, failed at a key level above, and looks like it's moving lower.
Okay, and the last one we're looking at is UNH, UnitedHealth Group.
So this is a fascinating one because UNH has been up for what, 30 straight years, it seems. It never stops, and it is finally rolling over. This is 2 times in a row now. We're starting to see it roll, so I would leave it. It rejected 480 and wants to move lower. I don't know what the meaning of this is because UNH has only rallied since I've really followed the markets. In 20 years, it's been like a god, if you will, in terms of stocks. I would leave it. Maybe 455 is the first support.
Okay. Well, Brendan, thank you so much for your time this week. Have a great week out there and good luck with it.
Hey, you too. And everybody, good luck.
For everyone else out there, good luck investing.